Hello everyone, welcome back to the channel. Guys, in this video I'm going to explain to all of you the way I trade the covered short Strangle, okay? And of course, I'm going to explain to you, all of you as well, why I trade this strategy, because in my point of view, this is way better, guys, than trade the Strangle itself. Why? Because we have that covered to the upside, okay? Especially for those of you that are beginners when it comes to trade options, having that call option covered by the 100 shares, 200 shares, whatever, how many contracts you might sell, it is very, very important, okay? And if you want to download, guys, this guide, just click on the first link below, and also you can download the trading journal for the strategy, okay? But I don't want to waste your time. I'm going to go straight here to the reasons why I trade this strategy and how we're going to trade and what approach we're going to have, okay? Because basically what you're going to do is, in this example here, for example, okay, using the IWM, which it is, in my point of view, one of the best ETFs you can use. Of course, why now is trading at $221. You might need a little bit money, a little bit buying power in order to take assignment if your first put get assigned, which I'm going to explain to you guys in a second. And the diagram we have, okay, the trading flow for our strategy, because our goal, it is to want 200 shares or maybe 300 shares of IWM. But what you're gonna do is, we don't want to pay market price, we want to buy all the way down here, and that's why we're gonna use the Strangle. Why? Because you're gonna start with the naked put first, okay? Because our goal, like I said to you guys, it is to acquire shares for the long term. If you do not have a long term in mind, this strategy, and of course my whole channel, has nothing to offer to you, because the way I trade option is like this. I want to sell my cash secure puts, I sell naked puts, whatever it might be, because the worst case scenario, I can hold whatever ETF might be for the long term, because that's the way I do, okay? Especially for those of you, like I said, that are starting right now, getting your feet wet when it comes to trading options, stick with the ETFs. Very, very crucial, okay? So straight to the point, without wasting you guys' time. Like I said, if you want to have all the background of the strategy, click on the link below and you can read all these, guys. But there's no point for me to bore all of you, explain all these things, because you probably know by now what does it mean, okay? But like I said, our goal is to own 200 shares of IWM. What are you gonna do? Are we going to pay, like I said to you guys, market price? Absolutely not. We're not gonna buy IWM all the way up here. We wanna buy 10%, 15%, 20%, whatever, how much discount you feel comfortable with, okay? So basically, we're gonna start pretty much with the cash secure put strategy, because I showed this strategy so many times in my channel. There's plenty of videos in this channel here. You can learn how to trade, how to manage, how to enter, how to close, all those good stuff, okay? So the first thing we're gonna do, we are going to sell one short put, okay? I said to you guys, we don't want to buy at market price, but if IWM, let's say, is already trading at 10%, 15%, you're going to sell at the money, or maybe in the money, because you're already selling at 10, 15, 20%. If it is at the all-time high, you're going to sell out of the money, okay? That's what we do. And in terms of the parameters, like I said to you guys, okay, I've got a trading here we're going to explain to you in a second. We're going to use, let's say, deltas of roughly 30, okay? If the stock market is trading at the all-time high, stick with your 30 deltas, 16 deltas, 20 deltas, and maybe 12 deltas. Depending on the volatility, you can still get a 12 deltas here and collect a really good premium for that, okay? So stick with those deltas for those of you that are trading with the market trading at the all-time high. If it is already discount, guess what? Go in the money, or maybe add the money, because you're going to collect a lot of premium. You're going to drop your base cost on those shares if you get assigned with that premium, okay? So we do step number one. If the put expire out of the money, what we're going to do is we're going to go back to step number one. Simple, cash secure put, okay? This is a straight cash secure put option, nothing else. If you have a plenty of margin, portfolio margin, you can call this thing here naked put. It doesn't matter. Okay, but if the first step here expire out of the money, which is selling a cash secure put, go back to step number one. Very, very simple. Okay, if in X days, let's talk about expiration here. Forget about trade management. If we do get assigned, what's gonna happen is our short put, okay, is going to be in the money. We're going to get assigned 100 shares. Simple. From now on, guess what? This become a covered strangle. So we went here from a care secure put. Once we get assigned, this become a covered strangle. Remember this? And look at this, guys. Does it sound familiar to all of you? This is just a covered call itself. So basically, a covered strangle is nothing else, nothing more than, okay, a cash secure put plus a covered call. Simple. And those two here become a covered strangle. Because the thing is, instead of having here a covered call with this thing here have infinite loss, okay, sorry, let me do this thing here. Instead of having here a strangle, okay, I strangle with this thing here have infinite loss, guess what? After the strike price here, for example, stock is here, the strike price of the call here, this thing cannot go to infinite anymore in terms of loss. Why? Because we have 100 shares here. So this call here, it is covered. That's why we call covered strangle, okay? So once we get assigned, back to the subject, sorry to go a little bit out of the subject, we're gonna sell one short put and one short call. Why? Because we want to sell the ratio of 100 shares to one contract, 200 shares, two contracts. So keep the ratio here the same, okay? And the put, we're going to sell one more put, because remember our goal here in the very beginning, we want to own 200 shares of IWM as lower price as we can get. Why? Because we're going to hold IWM for the long term once we hold 200 shares. And you can even sell covered call, it's up to you. But if let's say IWM is trading at 150. If in my second put, it's 100 with the base cost here 125, guys, I might just hold it for the long term. It's up to you. Do whatever you like, okay? But in this case here, if we are a second put and our base cost is going from 150 down to 100, guess what? I'm getting here 50% discount. I don't want to sell calls here anymore. We're going to cap this massive upside here, potential for $1. It doesn't make sense. We're going to hold long term. That's why we want to sell on ETFs. We want to trade ETFs because we know, guys, ETFs must to go up with the markets. Okay, otherwise, guess what? We're going to have way more things to worry about than actually our trades, okay? So here, step number 2, sell another short put and sell another call. If the put, okay, expire, let's say, out of the money, we're going to sell another put, okay? If the short call here get assigned, guess what? Those 100 shares is going to be called away, and we're going to go back to step number 1. We're going to sell 2 puts. That's the way it goes, okay? If, let's say, for example, in this case here, okay, this step here, let's say here, we have here trading at 100, whatever stock might be. We got a call here at 110, and we got another put here $90. If the stock goes up, goes down, and if it trades in between, this is gonna be out of the money, and this also is gonna be out of the money, which is in this case here, okay? What we're gonna do is we're gonna sell another call and we're gonna sell another put. But look, we're collecting premium. The whole time we're collecting premium, the whole time, okay? Until this thing here get assigned, and what's gonna happen is we're gonna own 200 shares and we're gonna sell 2 calls. So this is gonna become like what, guys? The covered call once we have our objective reached, which it is 200 shares. And then you're gonna sell 2 call options. And then when these 2 call options get assigned, we're gonna go back to step number 1. Okay, very, very simple. So going down here, for example, on the example, and like you guys can download this thing as well. Don't forget the first link below. Just click the button and then you can download this presentation here, okay? So in this case here, XYZ, I put XYZ. This was a Microsoft example long time ago because I had this thing on my files. You're gonna sell at 30 deltas to 30 days to expiration. This was the price, this is the strike price, this is the initial premium, and that's the break even. The break even is very simple, guys. Break even is nothing else than K minus P. K strike price, P is the premium. Very, very simple calculation, okay? So in this case, you collect 155 per contract. Of course, each contract holds 100 shares, so each premium that we collect needs to be multiplied by 100, okay? And all the way down here, what happened on step number 2, for example, okay? In step number 2 here, what happened is we got assigned. Remember, we got assigned this step number 2, 100 shares. So basically, care secure put, and now we have 100 shares. What I'm gonna do now is covered call and care secure put. Like I said to you guys, you know what I mean? So let me go back here. So now step number 2, we got a sign. So step number 2, we got a sign. We're gonna sell here. Let me go back to my pointer here. We're gonna sell here a covered call and gonna sell a cash secure put. And we have 100 shares here. So this is covered and we wanted this thing to get a sign. Why? Because when you get a sign, we're gonna go from 100 shares to 200 shares. That's our goal, okay? So step number 3, like I said to you guys, we're gonna sell one call option and one put option. 115 call option, 105 put option. And the strike price, it is in between here. Okay, in between here at $190.50, like I'm showing here. So we collect premium here on the call side, and we also collect premium here on the put side. And now, as you guys can see, we are accumulating premium, guys. Okay, this is for step number 1. Step number 2 here, these 2 premium here, as you guys can see. Okay, and we keep doing that over and over and over again. Okay, so our cost based on the shares, look at this, 160. Okay, why? Because we have all this premium here minus our S, which it is our stock price, and also our base cost. That's the power of the covered strangle, because if the stock, okay, stay in between the call and the put, we can keep collecting this premium here forever. And you go down from 16 to 14, 100, 98, 95, and so on. That's very powerful. And at the same time, we have our upside covered with the 100 shares that we have, okay? Very, very powerful. And of course, these I'm talking about here going to expiration. There's a lot of things you can do, trade management, you can close your options before, like the call option, the put option, you can close at 80%, 70%, 60%, and so on, okay? There's plenty of things you can do. But in other words, guys, we're gonna keep it going until, like I said to you guys, we reach, okay, let me see if I can go back here, until we reach this stage here, okay? Until we reach this stage here, which it is to get assigned another put and end up with 200 shares. Simple. Once we get assigned here on the second put, we got 200 shares, we're gonna sell covered call, and like I said to you guys before, if it is all the way down here 20-30%, we're just gonna hold IWM for the long term. That's the way it is. Okay, why? For example, let me show you something to you guys here. Let me go to my TastyWorks platform. For example, let's say 30 days, 45, 42, let's say 56 days. Let's say, for example, our base cost, it is, let's say, for example, our base cost, it is, this is hypothetically speaking, okay? They won't be that much. But let's say it's 240, for example. Actually, no. Let's say our base cost here, starting trading at 221, then our base cost is all the way down here at 200, okay? All the way down here. And if the stock drops all the way to, let's say, let's put more. Stock's trading now at 130, for example, okay? 130. And our base cost is all the way up here at 190. If you got, let's say, 130 here to not 190, our base cost, okay? Why are you gonna sell something here to collect $1 when you have $60 to the upside to collect? It doesn't make sense. That's why I do not sell covered call with the massive upside potential all the way down here. I want to hold this thing here for the long term. But what if we sell covered call in the money? Guys, even worse, because if you get a sign, you're going to lock in a loss. The best thing to do, hold for the long term. And that's why I said to you guys in the beginning, okay? That's why I said to you guys in the beginning, if you don't have the long-term view, in whatever option strategy you might have, I don't have nothing to offer to you guys, because my goal is always long-term, always. And that's why I trade ETFs. Because whatever the markets do, okay, the ETFs will pretty much follow, because they track the index. Simple, okay? But if we end up starting here 10%, 20%, 30% here, going from, let's say, 150 here down to 100 here, whatever it is, guys, I don't want to sell peanuts here, collect peanuts on covered calls. That doesn't make sense. Okay, I want to hold this thing here for the long term, like the bear market in 2022, or the crash in 2020, or the trade war in 2018, 2019. It doesn't make sense. This is called free money, free lunch. Free lunch doesn't happen every single day, okay? It do not happen every single day. But anyway, so this is basically, guys, the covered strangle. If you want to download this PDF, click the first link, guys, and you can have this for free. And you can suggest any change, things like that, what you can do here to make things better. And down here, you can see all the calculation, like rate of return, annualized rate of return. This thing here is very crucial, okay? Because my goal here is to have roughly, okay, 20 to 30% annualized. Because if I get 1.41 per month, guys, I'll be over the moon. If you, as an option seller, if you can make, let's say, 1% per month, you should consider yourself a blood genius. You should be a genius to get 1% per month. Forget about those nonsense, 10%, 30%, 40%. Guys, doesn't make sense. I'm talking about here, okay, on your net linked value. Don't come here and tell me that you're getting 1% on your buying power. I saw the credit spread for 50 cents and my buying power was 500. I'm getting 10% here. Guys, doesn't make sense. I want to see, you got $1 million. Okay, $1 million and you are making $10,000 per month. This is what I want to see. I want to see your return on your net asset value, on your net linked value, no on buying power. Okay, it doesn't make sense. But anyway, you guys get the point. You can have this thing here for free. Just click the first link and download. And here I've got my conclusion. And of course, this is just education purpose only. I'm not a financial advisor. This video here is just for education purpose only. But in a nutshell, guys, this is the covered strangle. If not, one of the best strategies you can ever use. Why? Because you have the long term on the shares. You got your call here pretty much covered. And you're still selling put way below the market price. Who doesn't want to do that? Guys, if you Warren Buffett do this thing all the time, let alone you and myself, okay? Just retail traders. That's the way to do. And the worst case scenario, like I said to you guys, I can have hold a bag here of 200 shares of IWM at 50% discount, 30% discount. You can apply this to SPY, XLU, XLV, XLF, XLI, XLY. You can apply this to all the ETFs. And of course, if you want to try to be a genius, you can adventure yourself on stocks. If I were to trade stocks, what I'll do is I'll go something like this. Okay? I'll go something like this. That's it, guys. The main stocks. Okay? And some of them here, it's not even like in this list anymore. Let me see here, guys, what it's not. McDonald's it is, Target, Nike. And Nike you can pretty much contest. Why now? Coca-Cola, Procter & Gamble, Walmart. This is the NH1, which is probably maybe the banks, Goldman Sachs, Bank of America, JP Morgan, the healthcare, Johnson Johnson, United Health. Guys, this is pretty much the main ones, okay? But you can make another list if you want. This is my personal list. But out of here, let's say make a list of 5 to 7 good stocks. That's it. You can have your Meta, your Microsoft, you can have your JP Morgan, you can have your UNH, you can have your Nvidia, you can have your Tesla. There will be volatility to your portfolio, but of course, bigger games. You can have here your, maybe, I don't know, you can have your McDonald's, very stable. You can do whatever you like, okay? So I'll suggest sticking with 5 to 7 stocks and getting to know those stocks, okay? Getting to know like the yearly low, the yearly highs, the average, and so on. Anyway, guys, this is my strategy. Very, very simple. One takeaway here that I'll say to you guys, the main thing which is going to make you profitable trading the covered strong, guys, it is this thing here, position size, especially on the first one. Because remember, we need to own 200 shares. You must be able to have enough buying power to acquire 200 shares. Doesn't matter if it's cash account or portfolio margin. That's our goal. But your goal might be 500 or your goal might be 10,000 shares. I don't know how big your portfolio is. You get what I mean, okay? But you need to do it step by step. Because remember, you need to be able to almost pretty much DCA in terms of put options. Because basically that's what we're doing. We are DCAing with cash secure put, nothing else. There's nobody here trying to be a genius, guys. This is very simple. I'm not trying to guess here price direction. I don't care about indicators. Nothing to do with that. If the price is all-time high, I only start my thing here at 10%, 15%. What about the moving average crossover, whatever it is? Guys, I don't care less. Forget about this nonsense moving average. You can have something as a point of reference. Your RSIs, your moving average, your stochastic, do whatever you like. As long as you are making money, that's the question you should ask yourself. If it works for you, my friend, good luck. I go in terms of percentage. I want to start at 10, 15, 20, and so on. Am I comfortable to hold IWM for the first time at 10%? Thank you very much. And the second time, what are we going to do? 20%, and so on. I don't care if they are size down, up, if the 50 is crossing the 200 or the volume profile. None of this nonsense, if you get what I mean, okay? Anyway, hope you guys doing very well. Don't forget, if you want to download the whole strategy with the trading journal, just click on the first link below. And if you have any comments, leave your comments below and I'll get back to you as soon as possible. Guys, thank you so much. I hope this video has added some value to you guys. And if you have any feedback, just let me know and then I'll get on board and we try to improve next time, okay? All the best, stay safe and happy investing.